mean, a lot of people start with something smaller than 100 units, and that's the most typical way. It's actually the the
Probably
suggest
the safest way.
safest way. Yes, yes, exactly. So I had the courage or to get started with the 220 units.
Wow. Hello, everybody, and welcome to the Total Wealth Academy video podcast. Please be aware that we have a radio show almost every day of the week, and we also podcast that. You can find this podcast and the radio show podcast wherever you get your podcasts, but you can also find them at totalwealthacademy.com. And what we try to do is bring you successful people who are helping change the lives of the members of Total Wealth Academy. With me today is Howard Wang, who is one of the people that our members invest with. He buys big apartment complexes, commercial real estate, and he's what's known as a sponsor or syndicator here at Total Wealth Academy. Howard, welcome to the podcast. I sure appreciate you calling in.
Yeah, thank you, Steve, for the invite. It's my pleasure being here.
The first thing I like to talk to people about is their history prior to real estate investing. And the interesting thing is some people don't have a history before. They literally graduated high school and started investing in real estate. Boy, do I wish I had done that. But let's talk about your history and corporate America. Did you start off in corporate America or did you go straight to real estate investing?
Sure. Well, talking about history, that'd be 10 years plus years ago. So I did some years in as a W-2 employee at a EPC company. So over there, I did project management, procurement. So it was a great experience. It was a fantastic experience. It actually bring me from Canada to te Texas, to the States. So that was a great platform. It was a great opportunity and experience. But I've always wanted to explore investment. So back in around 2015, I've started my first deal in a GP capacity, investing in multifamily in Houston. That's the start. I can share more story about that, but that's approximately the timeline where I got started around 2015. It was a great time. It was right around the recovery period. So we're on the up circle.
Sure.
Yeah.
Well, let's go back to the corporate America days. Why didn't you just stay at your job?
So I think a lot of other panels or speakers might have shared, right? Over time, I think the goal is to build some multiple income sources. And there's so many ways of doing that. There are a lot of successes. Um, and I think one way, at least for me, that I can find success is through multifamily. So first, it is real estate. It is tangible, stable, steady. Especially in te Texas, you get good cash flow from it. But then the strength with multifamily is you have scale, right? You can build a larger portfolio with multifamily, and the benefit of scale is not only larger, is allowing to support to have a more balanced budget. Specifically allowing you to have a budget to hire professional on-site staff, dedicated full-time on-site staff to professionally manage the property. So that is actually allowing the portfolio to to scale. I think that's a great benefit of investing in multifamily. And also the financing is different, right? With more multifamily, you get the agency loans, which are very liquid, and their rates tend to be lower as well. So you got some advantage over there as well.
And what got you encouraged to do it? How did you make that decision? I know you wanted to do it, but did you have a support system? Were you a member of a club? How did you get involved?
Yeah, everybody has the different way of starting. I think some people join clubs. Well, in my case, I've started as a co-GP. In this industry is about connecting project and investors, right? You need to have at least one of the two to get
Yeah.
started, right? With my background, I have both background in engineering and business. So I'm actually very into finding deal sourcing, underwriting, building relationship with listing brokers. So yeah, I actually can find a little bit more in depth, not just on surface, a more in depth dive in underwriting to find the true the diamond in the rough, as per se. So that's where I was able to find some project to get started with. That was back in 2015. And I think for the earlier stage, it's family and friends supporting to get started. And partner was another sponsor, also was regional in Texas. They've already have a pretty established track record, even at that time. So yeah, I mean, as long as you find a good deal, you have the equity raise, can borrow from Fannie or Freddie, and then have a supporting team doing the asset management, then I think you can get started enrolling.
And how many units did you start with? How big, and then how many units do you now have?
Yeah, it was a pretty unique perspective or experience as well. I mean, a lot of people start with something smaller than 100 units, and that's the most typical way. It's actually the the um,
Probably
suggest
the safest way.
safest way. Yes, yes, exactly. So I had the courage or to get started with a 220 units.
Wow,
Yeah.
that's
Oh,
incredible.
oh, that was incredible. I mean, even nowadays to think about that, it was incredible. I wouldn't suggest anyone to to mimic that route, but at the time, just stars were aligned. Yeah, so we, like I said, we have the factors ready to launch that deal. At the time, 2016 in Houston for a Class B, let's say 1980s deal, the cap rate was pretty decent. You know, there's still good cash flow at the time. I mean, remember when I underwrote at the time, we're targeting for high single digit, maybe occasionally 10%. Right,
On your
right.
cash on cash?
I was on my on cash on cash, right? So it's amazing how things have evolved over time. Um, but yeah, that's where I got started, and we sold that one in 22, and it was a good run. It was a very good run.
And how many doors do you have now?
Yeah, now we form a new partnership called Pine Spring Capital. So it's three partners. And on the partnership level, we have just over 10,000 units.
10,000. Wow, that's amazing. And
Yeah,
then as you continue to grow, you're actually in the process of acquiring more right now.
that's right. That's right. So my focus has been in the Texas market. That's the big four that we know, but In particular, I'll say Houston and DFW markets.
Yeah, it's tough to go wrong in Texas, and I hear Oklahoma's about the same. But Texas is just an incredible market. People are wanting to move here. It's business friendly, it's family friendly, uh, and I think we're going to continue to see massive growth in Texas, which is where I hold all my properties as well. Um, Tell us a little bit about maybe your favorite deal. Give us how you started off, what you end up selling for, what kind of rate of return did you get for your investors?
Sure, sure. Well, I'll continue the case or the example that I've already mentioned. So that deal, the earlier ones we acquired back in 2016 was a 220 units in Houston. Um, it's it's near Beltway 8, which has, great highway access and
Sure.
visibility. That's fantastic. We bought it at like I mentioned, a decent cap rate. I think, without mentioning specific number, what the philosophy or the investment, the direction is you wanted to create as much positive leverage as possible. That that is, you have, getting of course, on the high quality assets, a cap rate that's as high as possible, and then borrow at a fixed rate in cap.
Sure.
I'm putting that on fixed rate agency loan at a rate as low as possible. So you create a positive, healthy spread, that's helping you to generate cash flow. That's, I think, the guiding principle. So on that one, well, we bought it close to a 7% cap. Um, and
Wow.
yeah, yeah. Um, and we, at the time, I think the agency rate was for sure lower than today. I think was a four handles on it. So yeah, it like I said, that's how the high single digit or even a double digit cash on cash got created. And of course, it needs to be stabilized in 90% plus occupancy assets. So yeah, of course, we did the typical business plan like value add. Of course, we adjust to market demand, right? We don't go over on scope, but we fine tune to what market can support, what tandem can support. Um, so we hold that for, um, I think the base case was a 5-year hold. So right around 2021, we start evaluating potential sale. And as you know, what happened during that time, right? The asset price got up pretty quickly.
Yeah.
It's like every month there's some sort of new high or new record made, and it was very liquid, very liquid. Like it's almost capital chasing for projects, right? As long as you have some sort of projects. Um, but yeah, I mean, but we didn't pull the trigger in 21. We started exercise, so-called BOV, but broker opinion of value. But we kept on evaluating it. And then turns out in 22 there was a 1031 buyer that's off market, reaching out, interested in buying it. So, even in an on-market deal, 1031 buyer tend to be one of the higher bids or best buyer. So yeah, I mean, it ended up, I mean, we ended up selling it, sold it at around 4% cap. So
Wow.
yeah, yeah. I mean, I think market was awarding for patience. And, we didn't have to sell. We could have hold on for longer, but I think it was
An
not.
offer you couldn't refuse.
And yeah, exactly. I'm not going to confuse. Of course, I mean, we during that time there were also for just like any owners, right? You need to do the tighten up your operation, control your expenses, doing the value. We did all of the above, and we control the expense to a pretty optimal level as well. I think in terms of property management, it's not rocket science. It's more about consistency. It's about doing it over and over again.
No doubt. What was the rate of return for your investors? Do you remember that?
Yeah, it was that one was above 20%. Um, yeah, so it was not a bad one. Sorry.
20% internal
Uh,
rate of return?
above 20%, above 20.
Above 20%. Wow. So you more than doubled their money.
That's right.
Excellent. Well done.
Thank you.
What's the future look like for Howard? Do you continue with multifamily? Do you think you'll ever expand into strip shopping centers or buildings or any other uh, area of the real estate investing?
Yeah, yeah. So of course, within commercial real estate, there are a lot of different asset class. In the past, I've tried retail. I'm sure other groups had success on retail, and it's great cash flowing. Um, but I think over time, we've still found more success on multifamily, just on the risk-adjusted return basis. And also, it's tend to reward longer term holding. Is that what we all observe? So not only has the cash flow, but also a decent appreciation. Um, Also, we're exploring perhaps some new ideas. AI is very hot right now, but data center, how much we can involve in that? It's with you see on the news a lot of big players like Blackstone are actively involving it, but this is probably another level of arena. So, well, of course, we remain interested in exploring different ways that we can potentially evolve. But right now, multifamily stays to the core asset class.
Yeah, and just to define Howard Wang is one of the sponsors or syndicators here at Total Wealth Academy. He is a member that leads the deals, and our members invest with him in these deals. And as he described, he got them a 20% internal rate of return, more than doubling their money. This is somebody you could invest with too if you were a member of Total Wealth Academy. Um, as you look at 2026, what do you see happening in 2026? Do you see more of the same, or do you think 2026 is going to be a really good acquisition year? What are your thoughts on that?
Sure. So in the investment world, we talk about market cycles, right? And some of the primary perspective on it. Number one is on the macro level, which is the interest rate. Uh, so for 2026, I think market consensus now is about 50 bips cut. So we're in this rate decreasing corridor, although the magnitude and the pace is still TBD. It's always TBD. There's no,
Yeah.
right. But at least directionally, it's kind of trending down. So that's helpful to revive some of the market activities. Um, yeah, so that's on the in terms of interest rates. Of course, some factors that drive interest rate are number one, inflation, and then some of them, both the monetary and fiscal policy, as well as some geopolitical things going on that, like you see on the news, right? And then secondly is on the supply and demand. As we all know, there was a surge in supply in the previous years. Fortunately, we were seeing some decrease in that supply. and the pace is actually accelerating in terms of the decrease in supply. So looks like, well, because the new star data can be tracked. So it's actually rather clear that in 2027, which is next year, there will be bottoming out process for that supply. So that's also a welcome sign as well. And that will allow the demand to catch up over time to reach a more equilibrium market. And I mean that's what we're hoping for, a more equilibrium market. And in terms of the acquisition, what we're seeing is there's still tons of activity for the newer vintage. So that's post 2000 vintage. There's still tons of offers, tons of activities. And of course, for anything older than that, there are multiple offers as well. But I think going forward, if 2027 is rather a turning point, then position ahead of time, which is this year, 2026, might not be a bad idea.
Okay. And in conclusion, I like to ask people what their favorite book is. Um, what is your favorite book and why?
Um, yes, I think there's one book. Um, need to get the name. Mm,
Take your
So,
time. Take your time, Howard, while you're coming up with that, and I'll give them our website. Our website for our reading list is totalwealthacademy.com/books, totalwealthacademy.com/books. And I can't say enough that when it comes to being successful in any aspect of your life, you want to read, and when you're done reading, read some more. And there's some great books at totalwealthacademy.com/books. And we're trying to find out what Howard's favorite book is.
so the book name is the Almanac of Naval Ravikant. So in this book, I think he talks about how to think a little bit differently, not just in terms of wealth, but also what is true happiness. He mentioned importantly relationship. I think there's a study in Harvard that actually echo on that point. Like longer term, yes, wealth is important, but what drives happiness further is a healthy, good relationship. Um, so yeah, I mean there are a lot of great points. I think every page on that book has some sort of great points. So
And what
highly,
was the name of it again?
um, I'll post the link, the the Almanac of Naval Ravikant.
Wow.
I
I have
might
not
not,
heard of that book. I will check it out, Howard.
yeah, I might not get the exact name correct, but I'll share that link in the chat. So they have that. Yeah, I'll share that link on in the chat.
All right. Sounds good. All right, Howard. Thank you so much for coming on the podcast today. I truly appreciate it. Viewers, if you are interested in investing and you would like to invest with people like Howard, please check out Total Wealth Academy. We buy, oh, good Lord, 40 or 50 big commercial deals a year. And as the members of Total Wealth Academy are the investors in those deals, if you're interested in doing something like that, please come to our free sample class. There's a link below. Thanks, everybody, for watching. Have a great rest of your day.
Thank you so much, Steve, and I wish your audience well as well. But best wishes in the investing venture. Thank you.
All right. Thank you, Howard. You take care.